And in fact, with these databases, it's quite simple to extract these stocks because you just feed in the information and it will automatically give you the ticker names. Using that ticker names, you can then extract the. So it's essentially it's a data. The chances of making an error is pretty much zero, okay, because all those stocks are just captured in the system.
Assalamu alaikum. Thank you for your presentation. I have just one question concerning the variables that influence the stocks. You limit the sets to financial and macroeconomics. Why not institutional factors? I raise this question because now when you go to the database of the World Bank, you can have indicators on these institutional factors through the CPIA, Country Policy and Institutional Assessment.
Yeah. No, that's important. I think it's work that is evolving, and I'm institutional factors. The problem there would be, if you are doing financial economic work, at the minimum you need monthly data to make sense of it. You can't do these things with annual data, because annual data does not. The reason is annual data has got no information content from a financial economic point of view. That's why having monthly data is imperative. You talk about financial institutions and Islamic finance. It will be difficult to get the institutional data on these stocks. You might be able to get it at the country level, and that work we have already done. Not necessarily, yeah. So emerging markets, there are some Islamic countries that we consider. There's a paper that it's forthcoming in the Pacific Basin Finance Journal, which looks at 40 countries. So at the country level, yes, you can do that. And we looked at things like corruption, for instance, a corruption index. We looked at democracy and other indicators, rule of law, involvement of military in politics. So there have been studies already done in that respect. But the idea here is if you move away from looking at the index level to the constituents, like the stocks, like the story that I've been telling here, it will be almost impossible to think of you can get data on institutions from 1980s. You might be able to get it for the last 5 years, but then you are no longer looking at a framework and at the type of research questions that we are putting in here. It then becomes more sort of corporate finance type analysis where you can run cross-sectional models and so forth. It becomes a completely different research question in a different environment. So I think that in itself, institutions and financial markets is an interesting subject, but whether or not you would be able to do it within this time frame, I don't think so. So that's something maybe corporate finance as this research multiplies and becomes more popular, maybe someone working on corporate finance might be able to look at that. Perhaps I think it would be a good PhD research topic to look at that.
One question. First, thank you so much for a very interesting discussion. I'm particularly interested in your new economic model for price discovery. My question is, when would these findings be available? Do you have a tentative date for that?
You'll have to ask Mansoor because he's guest editing the journal. We have submitted 2 of those papers.
So, this year or next year?
I think it will be published next year, right? If it's accepted.
Do we have any more questions?
I just want to ask if the data set available for public or for researchers or not.
Yes. So once the paper is published, because we might still be revising it and doing more work with it on those papers. So I think once the paper is published, hopefully by next year, I will make available the data set.
Do you have one last question from anyone?
Not on institutions, right?
No, sir. I just want to understand it at the beginning of your presentation, this apparent paradox between high credit and low return. Can you explain me? I don't know.
Yes. So that's quite simple actually, at least to me, because, and I know it would be difficult if you are not working in this area. So think about you and me as two companies, right, that trade. And if you have a bad credit quality, the chances, what it means is that the chances of you defaulting on your financial position is high, right? So you will be then a risky company to invest in, because the probability to default is high, or your credit quality is low. Compared to me, I might have the opposite situation. I might have a very good credit profile. The chances of me defaulting, because I pay all my debts on time, I have a very good and clean record, the probability of me defaulting is low, high credit profile. The question is then for an investor, whether that investor should invest in your company or my company. There's a risk. So as soon as we talk about the investor, the risk comes into the picture. Should the investor take more risk? If the investor wants to take more risk, he or she will invest in your company, right? Because you are a risky stock. Your firm is risky, right? And the chances are that if that investor invests in your stock, he or she will make more profits if you don't default. That's the risk, right? If you don't default, the chances are you're going to make more profits. If the investor, by comparison, invests in my company, there's very little risk, and he would know from my performance that he's going to get a 3% return, right? In your case, he might get -3, but he can also get 17% return, right? So that's the idea. The relationship between returns and credit quality is the same as when we go to the bank to borrow money. The bank will do a credit quality report on you, look at your history of transactions and so on. Accordingly, they will give you a different interest rate compared to me, right? So they will charge you a higher interest rate on the loan it gives you, and they will, by comparison, charge me a lower interest rate. Why? Because they will know that I'll pay my mortgage on time, you won't. Or the chances are that you might default. So to compensate the bank for your credit quality, they will charge you a higher rate. Right? It's the same sort of thing. So the bank makes more money from you by charging you a higher interest rate than from me. So the bank is investing in you, right? And it's investing in me, but the returns from you is higher. At the same time, the chances of the bank making a loss from you is higher. Just like that.
Okay, if there are no more questions, we will proceed to end this session. But thank you everyone for your questions. I would like to invite Professor Dr. Osman Al-Habshi to present a small token of appreciation to our guest speaker today.
Thank you. Thank you. This is
Video. Yeah.
But it looks like I'm giving it to you.
Thank you very much, Doctor. Thank you, Professor Paresh Narayan. Thank you everyone for coming. We have refreshment provided for you at the pavilion. Thank you once again. Assalamualaikum warahmatullahi ta'ala wabarakatuh.
Thank you.